Yeah, August was very interesting month where there's a lot of different forces going around the world. So obviously, central banks have been tightening, trying to fight inflation, and through the first half of the year, that really dragged markets down. People expecting economies to go into recession, and risk appetite was really increasing. And then we saw the dynamic shift a little bit in July, where there are some signs that growth was slowing down. US had a couple of quarters of technically negative growth, and some signs things like global manufacturing had peaked, and some of the price pressures coming out as spending shifted from goods back to services, and a lot of companies appeared to have too much inventory, and that gave markets some cause for optimism, and bonds rallied back down a bit, and markets recovered, and there was a big surge in risk appetite through July as markets essentially discounted the need for a recession and started pricing in easing in central bank policy through mid-23. And then August, some of that started to consolidate at the start of the month. Risk appetite was still improving. People were looking once again for improving earnings. You obviously had a lot of disruption in Europe with the Russia-Ukraine war and sanctions against Russia and retaliation through shutting off gas flows to Europe, and you're seeing an emerging energy crisis there. So that helped actually buoy oil and gas companies, which were lifted by stronger pricing there, much stronger coal and LNG pricing, and some hope around China that after slowing down and having some real headwinds in their property sector, that some interest rate cuts, they cut some of the official lending rates, would start to see a bit of a recovery in activity there. So resources are also broadly strong through August. And then we moved into our reporting season where companies were actually reporting pretty good numbers. So you saw things like surging travel demand for companies like Qantas, strong realised resource pricing for miners, and big dividends and buybacks occurring through there. And the banks reported reasonably good numbers with very low bad debts, in fact writing back previous provisions. So that all helped to buoy markets until pretty much at the end of the month, where you saw Jerome Powell speak at Jackson Hole and give a bit of an outlook for where reserve policy would be going, and he disappointed markets, basically saying inflation's going to be a much longer fight. The biggest mistake that was made in the 70s was easing too early and not getting inflation under control. And there's pretty much no way they'd be easing rates through 2023, and they'd be higher for longer, and they're prepared to sacrifice near-term economic growth to get inflation under control. And markets sold off a bit more sharply towards the end of the month. So pretty volatile and interesting, a lot of different dynamics going through there. Yeah, August was interesting in terms of fund performance and in terms of right across our different active funds. And that was really down to a lot of what was happening through reporting season. So the funds drew down a little bit in July as that big risk appetite moved through markets with more optimism around recovery. Some of that started to just normalise through August. It stopped moving, but then markets focused back on companies reporting earnings in the second half of the month, and we did quite well through that period. Particularly in areas like our defensives group and across our resources group as well. So we did very well in stock selection through defensives in terms of where we were overweight. Stocks like Medibank and Telstra doing quite well in terms of delivering strong earnings and upside. And areas that we were underweight generally delivered underwhelming earnings and downgrades or cost blowouts and disappointments. So you had stocks like TPG have weaker pricing in terms of postpaid mobile. You had ASX with weaker trading volumes and blowout in costs as they're implementing a whole lot of new IT platforms there. Endeavour Group pulled back from stretched valuations and a bit of a weaker mix of business between on-premise and off-premise. So there's a lot of different dynamics there that generally help fund performance, and within the resources group as well. So obviously that surge in energy prices around the world, with Europe very much at the centre there. So gas prices driving up. Australia benefits a lot from that. Our oil and gas sector is much more tilted towards gas and LNG than it is towards oil. So that benefited stocks right across the board there. So stocks like Santos and Karoon, where we're long, did quite well. And then also you saw a lot of strength in the lithium stocks. So we're positioned broadly overweight there in terms of that transition to electric vehicles and demand for lithium-ion batteries going forward, and some of our overweights there with reporting good production volumes and better realised pricing, and a bit of a catch-up with risk appetite through July as well. Performed well, so stocks like Allchem and Pilbara Minerals all did pretty well on the upside. So they're two key sectors. Yield was also quite a good sector, where we'd taken a few profits on Computershare, but moved back into that at lower prices after it reported. Some of the banks pulled back after having very strong runs into reporting season, where we saw generally very good performance in terms of provisioning and the ability to write back previous provisions, and not impacted at all yet by interest rate rises, but a little bit of disappointment near term in reported net interest margins, and the benefits from lifting deposit loan pricing, lifting faster than deposit pricing, wasn't flowing through as much as expected, so they gave back some of their performance, where we generally positioned a bit more underweight. So all those areas were quite strong. There's some good miscellaneous stocks across cyclicals. BlueScope reported quite well, performed well. Qantas, a lot of the travel stocks, Webjet as well, gave strong results, reflecting that increased demand to travel again, and some of that tightness still in market capacity meant very strong pricing moving through there for stocks like Qantas, which reported a strong rebound in earnings and was able to announce a buyback. So the outlook for the market for the rest of this year and into 23, I think it's going to continue to be dominated by broad macro factors, specifically what's happening with inflation and what central banks are doing to actually control that. So there's a couple of different forces moving around in different directions. Inflation's potentially actually peaked at this stage already, as the global manufacturing cycle rolls over. A lot of companies have built up too much inventory, and as consumer demand switches from goods back to services, that's likely to take a bit of the heat out of supply chains and tradable goods inflation. But on the other side of the coin there, you've still got very tight labour markets, wages growth has been accelerating, and you've got this massive energy shock in the background as well. So it's almost unprecedented what's happening in Europe, and the interruption to gas supplies that's occurred around that Russia-Ukraine war, and it doesn't look like it's going to be fixed in a hurry. And that's feeding through into higher energy prices, and not just in Europe, but it starts pulling in tradable LNG and gas from the US and Asia and other markets, and tightening up global pricing as well. So that's likely to create broad inflationary pressures that are going to continue to feed into the profitability of companies, and keep wage demands high from workers and households, and provide a bit of a challenge for central banks. So they're going to be very wary of easing too early, and markets are going to be dealing with some of those mixed signals of some signs of inflation improving and economic growth slowing, but still ongoing tightness. So the market will, I think, be quite volatile around some of those signals. We'll be looking to focus on what central bankers are saying and how they're projecting policy moving forward, but we're generally quite bearish in terms of a high chance that we're moving into a recession through 23 as policy tightens to the point where it starts to break things, and you start to see stress in companies and households, labour shedding, some slack back into labour markets to get inflation under control. That's generally not great for the earnings outlook. So we see potentially higher interest rates pressuring valuation multiples, and also earnings pressure there with the recessionary environment dragging down markets. So we're really looking to position around that, select the best stocks within our groups to keep ourselves neutral to some of those broad market dynamics, while still utilising our ability to make money through active stock selection.